So many investors assume that ETFs are going to be the best choice for them to start in the stock market. Now, in truth, though, they might not be the greatest option. Now, sure, they track the market, but they don't always beat it. And yes, they are diversified, but probably not as much as you think. And while they may seem effortless, there are hidden costs. Now, despite the title of this video, I don't hate ETFs. They can be a really great way to have a ready-made portfolio for you. You don't have to think about what goes into it. Somebody else has done the work for you, and all you have to do is invest in an ETF. They're simple, they're generally safer than trying to choose stocks on your own, but they aren't always going to give you the best return. Now, I currently do hold 2 of them in my portfolio, and those 2 ETFs make up about 15% of my entire portfolio. The remainder of my portfolio is single companies. So let's talk about what I mean. So last year in July, I did a comparison comparing what would happen if you invested in the same companies as an ETF. And I used VAS, the Vanguard's Australian Shares, as the benchmark because that's the most popular ETF in Australia. And while it wasn't entirely fair, I was actually putting the top 10 companies within VAS against the whole of VAS. I did that because over 50% of the fund is made up of just 10 companies, and we'll talk about that in a minute. But I was comparing 10 against over 300. And the other flaw was that I was looking at the top 10 companies in VAS today rather than 10 years ago and looking over a 10-year period. I did actually try and find what the companies were back 10 years ago, what the top companies would have been in that fund, but I couldn't find that information. But let's be realistic. The big companies within Australia by market capitalization have not changed that much. So I don't think it's unreasonable to think that the majority of them would have been in VAS in approximately these allocations. But anyway, what I found was the difference was stark. It was quite shocking even to me at the time. You would have made significantly more if you had have invested in the top 10 companies from VAS compared to VAS itself. So over 10 years, VAS, you would have received 45% increase, which is amazing. But if you had have invested in the top 10, you would have got 143% increase. That is crazy. That's due to a couple of really high returns such as CSL and Goodman Group and even Macquarie Group. But gosh, that is such a significant difference. That's a $10,000 difference. I need to process this for a second. This is not to say that VAS is a bad ETF. It's actually one of the really good ETFs that we have. But the nature of ETFs overall does mean that you're never going to be anything more than average. Now, I've talked about this before, that average is still great. Average is still going to make you a lot of money. But it does beg the question, are ETFs as great as they are marketed to be? Because make no mistake, they are products. We are being sold a product, a ready-made portfolio, if you will, of different companies mixed into a fund. And who doesn't want a simple, ready-made portfolio where you don't have to think about it, you're instantly diversified, and it tracks the market easy? It's also why so many people have access to investing now, which is a brilliant thing. I love that more people are getting financially educated. I love that more people are able to build financial wealth. And while it's open to so many more people these days, we still have a long way to go. But I love where we're going with financial education, especially in Australia. But anyway, let's go back to the main point of why I think that ETFs underperform and why I think they may not be the best choice for every investor. Now, the main reason people like ETFs is that they're instantly diversified. And I agree with that. You are instantly diversified. You have a whole host of companies within your fund now. However, they're not always quite as diversified as you think that they are. I was talking about VAS earlier, and the top 10 companies make up around 50% of that fund. And the rest, the 290 companies, make up the rest of the more companies that's held in the fund, the less this is the case, but it's still very much weighted towards the biggest companies by market capitalization. IVV, which holds the S&P 500, the top 10 companies there, they make up 36% of the entire fund. And my favorite ETF, VHY, Vanguard's High Yield, they hold about 70 companies, I believe. 64% of that fund is just made up of 10 major shares. So that's what I mean when they're not quite as diversified as you think that they are, because they're heavily weighted towards those companies that have the higher market capitalization, the biggest companies within Australia or wherever you're investing. The next is the problem of over-diversification. Over-diversification, or holding too many companies or too many stocks, is going to dilute your profits. It not only dilutes your returns, it's just going to complicate your portfolio if you hold too many companies. Peter Lynch, who is a popular money manager, he called it diversification because it usually makes your portfolio worse. I think that's really funny. And of course, we have that famous quote by Warren Buffett.
Diversification is a protection against ignorance. I mean, if you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably, because there aren't that many wonderful businesses.
ETFs, while they are an investment tool, are just becoming a product to sell to consumers, to new investors. Fund managers keep launching new ETFs to attract new investors, and sometimes they prioritize not what's going to perform best, but what's going to appeal to a mass audience, to investors, beginner investors especially. They've become more a product to sell, to market by these fund managers than it is to help investors maximize their returns. And I'll briefly mention fees as well. I don't think this is as much of an issue, especially for passively managed ETFs, but for actively managed ETFs, you can be paying somebody else quite a lot of money that will eat into your profits if they're constantly buying and selling and actively trading. So that's something just to keep in mind. But those are the reasons why an ETF might not outperform the market as a whole and generally doesn't. However, there is one other thing that I want to discuss, and this is something that I've been thinking about a lot lately. And I'm sure that there's some really smart people that watch this video that can add more insight to this, because this is just thoughts I'm having at the moment. The biggest flaw I can see with ETFs is they create some sort of unnatural bubble in the market. So a bubble in the stock market is basically when investors are pouring more and more money into companies and overinflating them, when inevitably when a crash comes, the price will then drop quite dramatically. This can, of course, occur whether you're buying funds, whether you're buying single stocks, any investment. But as ETFs become more popular and people want to put more and more money into them, the fund managers then have to keep buying into these companies, which is going to inflate the price. They're pushing money into these huge companies, whether the company's worth that or not. And because all of these ETFs are weighted towards the bigger companies, they're just going to get bigger and bigger and bigger and overvalued. And that's what kind of worries me, is how much these larger companies are getting overvalued these days, simply based on investor demand or demand for these funds that have to keep buying more and more of these companies, especially the top 10 within that fund, which within Australia is generally the banks and the mining companies. So whether you think that's creating an artificial bubble or not, let me know your thoughts on that, but it is something that does worry me. Anyway, I hope you've enjoyed this video on my thoughts on ETFs. Remember, I don't hate ETFs. I actually think they're a great investment product, especially for beginners. But I do think that you're never going to beat the market with them, because they are the market. Anyway, take care, and I'll see you in the next video. Mwah!